The importance of booking profit in stock market. My investments in stock market are yielding good profits.
That's nice. So, have you booked your profits?
No, I am waiting for my profits to increase.
You should book profit immediately.
I am a long-term investor, and I will wait for much more returns.
Many long-term investors lack one thing, and that is long-term strategy. They just buy the stock and hold it for their desired time period. There is a difference between long-term investment and long-term investment strategy. When one invests in stock market, it is very important to be aware about the condition of market and our stock as well. If an investor books profit at right times, she can increase their returns by many times.
So why don't you tell me the reasons to book profit?
Okay. First, volatility of market. We all know that stock market is highly volatile. This volatility of market often makes it difficult for us to decide our entry and exit point in a stock. The stock markets of all the countries are linked. You must have heard about the recent Greece crisis. And we saw how badly a small economy crisis altered the movement of markets of all countries. So, with due respect to the volatility of market, one should book profit. Second, emotional attachment. We all get emotionally attached to the things that stays with us for quite some time. The same can be said about the stocks. We all get emotional about the stocks that we own. In my opinion, this is a major reason why investors don't make money in the market. If one overcomes their emotional dilemma, then it will be very helpful for them to make money in market. Third, volatility of stocks. As markets are volatile, in the same manner nothing can be much predicted about stocks volatility. This is another reason to book profit. The stock that is among the gainers today might be the top loser next day. That's the unpredictability of stock as well as stock market. Maybe the stock chosen for investment by an investor be a dark horse today and become a lame one after 2 years. In that situation, it will be better for the investor to square off his or her positions at that time and switch to some other stocks for better returns. Fourth, temptation to average out. An investor adopts this strategy to decrease the buying price of a stock in their portfolio. In this strategy, they buy stocks when the price of stock goes beyond their buying price. It is advisable to all the investors that they should average out their stocks only during the up move of stock, as no one can predict about the bottom of a stock. When an investor goes for averaging after their stop loss is hit, then they are being trapped. It is always advisable to get out of a stock when it is in its bear phase, as no one can predict the bottom of stock.
I get it.
Many argue with me on the above reasons, that if we trade very often then it will impact our tax paying. I absolutely agree that in such cases of high trade frequency, it will be considered as an income from business and profession, rather than short-term capital gains. Worldwide, market experts have the opinion that one should look for opportunities in the stock market to earn money, not about paying taxes on earnings. As I have learned from my mentors, that stock market moves up or may fall down, but smart investors are the one who make money in both the kinds of market, irrespective of movement of market. Stock market does not apply a retarding force to their investment plans. In the bad phase of markets do not erode much amount of their portfolio. So, one should always look for opportunities available in the stock market. And it is also true that no one can time markets with total accuracy. It is important to have a target and stop loss for the investments being done to survive in the market.
Well, thank you. I will definitely book regular profits from now onwards. For more information visit protradings.com.